This is Justin Pulitzer. This is my weekend review video for Sunday, July 26th, 2015. There's a lot to cover. I'm going to start off a little bit differently than usual, and I'm going to start off in commodities. At any given point in time in the market, technicals or macro or fundamentals are kind of play the more important part. And I think here some of the fundamentals and some of the macro is going to lead here before the technicals with regard to the equity market. So I wanted to discuss that with regard to commodities. And you can see here we had this big run-up in commodities in 2007 and 2008. We all know how that ended with a really big crash in oil. And since there has been rallies back up, it's gotten roughly to about 110, 114. And in the last few months, the last year or so, it has absolutely rolled over and pretty much crashed. Not quite back to the old lows here in the beginning part of 2009, but did get to trend, retested the trend, had fairly feeble of a bounce. I had been expecting this to see 67s and possibly 75s. I actually still do at some point. I just don't know what the order of operations here are going to be. But this 45 here is a really key level that we're coming back into for it to hold. And I had said that I thought anything below this 54.24 was going to be vulnerable back to 50, and anything below 50 was vulnerable to the lows. So we may have to recheck them one more time, so to speak. This video really, I'm not really so much, this isn't really so much as to pick up a bottom in oil or a spot to even buy it, but it's more to just show the violent move that has happened in commodities like oil. It's starting, I wouldn't say it's even starting, it's happened in commodities like copper. You can see that this $2.90.994 was a floor for a very long time, and then we've now broken it, checked back, failed, and now coming back down lower. This isn't quite as weak as oil, but we all know Dr. Copper, and that is sort of the tell for both U.S. and global growth, particularly with China, where the world has sort of been counting on for the growth engine. And if that is starting to stall out, that could be some trouble, sort of some storm clouds on the horizon. Gold has fallen apart. You can see it's just been, it started out as just this kind of sideways listing consolidation for a while. Now it is breaking down and making new lows. This 100.44 as well as this 91, which is sort of a channel low, are going to be, this kind of leg here is going to be really key here. I've been looking for it as an area to kind of buy the dip, so sometime in this next move, potentially this next move down. However, it wouldn't shock me to see some type of a check back here closer to the 109s or 111s, maybe even as high as the 114s before the eventual maybe further rollover. But I'm really kind of just showing you this because everything else has sort of been starting to roll over. You can see even in the semiconductor index, this has been in a kind of a bullish move for a while. Here, it started to, like right over here, started to lose the primary trend that we've been in since the 2011 lows. It subsequently made new higher highs. So this is getting to be, some things are starting to kind of, there's some flies in the ointment. We're DAC bound below. Now this pullback low here, we're just getting to there. So the 641 level here is really key. We closed just above it, but if we get a little lower, this 623.63, the 61.8, and also this now new trend line, because we did make a higher high, this low here, this here is going to be really key, particularly with equities. Some of the things that are showing some signs of weakness are Intel. Look at this. These are big stocks that don't quote-unquote matter until they do, and this will start to matter if this breaks down, and you can see it already is starting to break the trend line. You have the left shoulder here, the head, the right shoulder. So it wouldn't shock me to see some type of a pullback here, maybe into the 26s, maybe a throwback here to the 29s, and then the eventual rollover, if it is to roll over. But these are really big, important things that could be leading the way for trouble in equities. I mean, you can see, I showed you the charts in commodities. The one that has kind of held up here is the equities, and they have just been listing sideways for the better part of a year. The talk that has been on the street that I've been hearing from fairly intelligent people is that maybe this is going to now want to roll over like commodities and retest the 2007 crash, the pre-high, which was, believe it or not, all the way down at 1500 in the 1500s, almost 1600s. Now, the one thing I want to caution, everyone has been very quick to call the top in the market, and I'm not necessarily saying this is. It's very possible there is some type of sideways consolidation here, and then a blow-off top to go much higher. However, in 2007, we didn't see that. We did see this kind of like sideways consolidation, this bit of a break down below range, the check back, and then, things, we all know how things went. They got really fugly fast. But we did get the 1.618 Fibonacci extension. If you take the level here from this low and you project it up, we have tagged it out, and we are just kind of going sideways. This is a very important, significant level for the S&P, and it is teetering, in that area. So if this does have some type of a rollover, it could get kind of ugly pretty quickly if we lose the channel low. Let's flipper back to SPY for a minute. I'm frozen here, so just bear with me for a second. This is very annoying. All right, the platform is frozen. Here we go. All right, sorry about that. So let's bring us a little bit more into modern time here and talk about what's the key levels here before we have to start getting too nervous about anything. And there really, believe it or not, isn't that much to be super duper nervous about just yet. So one thing, though, that is disturbing with the pattern here is that we are starting now for the first time. We've been making these 100% retracements for quite some time, for the better part of a year, and we are now starting to do something that's a little bit different. We are making now lower highs on the rallies and lower lows on the declines. That is pretty disturbing. So I would say that we now got the 61.8 fib of the range here, from the range we've been in from this last leg. This is a very key hold. If we lose that, I believe we'll see the 200-day moving average fairly quickly, which is in the 206s, likely the range low of the 204s, and potentially, I've been saying for a while, it's been strange that we haven't tagged it out, was this old high in the S&Ps, also this gap that kind of got this move going in the 201.90s. That would likely also coincide with the channel low and trend, which would be a great spot to get right or right out long for in size for some type of a bounce. If it breaks, then GTFO, because we could be seeing down here into a new range in the 199s, maybe the 200s, the 199s, and maybe even the 198s. So what I'm thinking is, if there is some type of weakness early next week, to buy some type of a put ratio, playing for these lower levels, break evens down here would be down near trend. If we do rally back up and we do take out this leg here, then I would say the blow-off type of scenario is likely in place, and we'll probably come up and retest these highs fast and do something just like completely blow up. Some of the things that you want to look at here are IWM, which is now making a significantly lower low here than this one, and we are coming back down into a really key level. This 120.97 is really key. If we start losing much below that in the 200, which is 200.57, maybe it winds up coinciding by the time it gets there, then I think that there is some risk significantly lower. I do think that these 119s and these 117s will also have some muscle memory, particularly the 117.37. I've discussed that for a while. There's a gap fill. There could be a little bit of a push through to this gap fill here to this 116.76, but roughly close to 117 to me is really the key pivot, and I would be looking for this for some type of a right or right out play if there is going to be some type of a bounce. Like if we break down here hard, then I'd be playing for some type of a bounce back up to like close to the 121, and I think that would be a fairly decent play. Qs have had relative strength. We all know Apple and Google have been fairly strong, although Apple is starting to show some signs. We'll discuss that in a minute. This did have some type of a fairly large move. The Qs made the new highs. Now we are coming back down to retest, and I had said in last week's video that the strongest scenario would be to retest this 117.16 and then bounce. However, there is some room for give down to this 109.42 for it to still be quote-unquote healthy. sometimes you do wind up in come and check back mid-range of the prior range that you broke out from. So I'm not really that alarmed just yet in the NASDAQ. There is some room to the downside that would still quote-unquote be healthy. You could also see the 61.8 of that move is roughly around the 109s, which to me is close enough for government work. You have a 50 and a 20-day moving average, 100 right below there, which will probably coincide with that. So there's probably going to be a lot of support in the NASDAQ and a little bit, maybe just a smidgen lower. Apple ran up into the earnings, started to break the downtrend line, and then just gave it back up pretty quickly. It in the pre-market here of this day did recheck into the 119s. It held those lows. We never saw that low in the in the regular trading hours session, and I had said that I thought we would start to see some resistance up here in the mid 125s, potentially up to the 50. We didn't even get to the 50, which should show you there's a little bit more weakness in Apple. I do think that it's possible that we retest the 122s and potentially these 119s. I do think down here would be a good right or right out type of a play. If that fails, and we are starting to lose the channel here, you see we lost it, reclaimed to the middle of it, now we're losing it again. Then I think there is some more room down, potentially into the for the gap fill down here, somewhere between 115 and 110. Let me see if I can back the chart up a little bit. Yeah, you can see this is really where this move took off here in the 109s, 110. If this starts losing these 119s, that is going to be what people are going to be talking about. These reference lows in the 115s and potentially the 109s to 110s. So there is some room in Apple if we start making lower lows in the chart. Google did something that was really rather kind of cray-cray. It ran up $50. It then had another $100 move. I had said that I thought over this 103 was going to be would be a long for a continuation play higher. I did attempt it a couple of times. I got stopped out. A little bit of a hand slap, nothing too serious. But we did now lose this low here, this 678, which could coincide. I didn't think that this would get lost so quickly, but we are pulling back. There are some fibs here that are important. The first one is going to be the first one here was 657s. The more key one, the 61.8 of the range, is 644. That's from the gap to the high. But if you go from the move low to the high, the 50% comes down in 625s, and the gap fill, which is also the 61.8 down here in the 605s, is really key. I actually am going to play for this early next week, particularly if there's some weakness. I'll do it with a put ratio. I'll probably buy like a 620, 605 or 620, 600. Same week expiration for a move back down to fill here. That ratio would, you don't want to go too long because it's, it will have some positive delta when it does come down strong, and you don't want to be under too much pressure. But I roughly think somewhere between the 605s and the 615, which was the old Google high, would be some very strong support. That would also be like $100 off the high. So we'll see how that moves. If it moves down there rather sharp, I probably would be interested in selling some out of the money puts. I do think that area will hold. Their numbers were pretty good, and I just think it got a little bit sporty, so to speak, with the rally and then the big move afterward. Facebook benefited a lot from the Google move. You can see it had been strong, consolidating, and then it just kind of ballooned up. I discussed on the stream that I've said for a while I thought Facebook would get 100. We stopped just shy of there, around 99.24. I had said that between 99 and 103s were the areas to start taking profits. Wouldn't shock me to see us still go a little bit higher in Facebook, but I would be a little bit cautious here, considering you did get a lot of this move here thanks to Google. I don't know that I would be chasing it here. If they do something like crazy, like pull it back hard into the number, then I would be interested in buying for a dip and playing for some type of a bounce on the numbers. I just don't love chasing stocks that have already had big moves pre-numbers based on other numbers into the numbers. Yeah, it could still go higher, but risk-reward setup would not be in your favor. I would would like if this did just chop sideways or even come down a little bit, to maybe retest some lower levels if there's some type of a panicky sell. Maybe people are looking to take profits ahead of the number. Then I would be a little bit more interested in Facebook. Twitter, I think, is going to be a binary trade. I think it's either going to retest the lows down in the 29s, or it's going to come back up and retest closely to about the 45s. A lot of people know that their user metrics are lower. There have been, Dorsey is a lot. There's not that much confidence here with him. So these numbers are going to be really key. When Twitter announced Costello's leaving, the stock got up to 40.45. You really need to clear that for still higher. But they did reaffirm their numbers, but they kind of hinted that their user metrics were going to be lower, potentially a decline for the first time in a while. I think a lot of people are kind of playing wait and see with this. So I do believe that this is a binary trade either to 29 or to 45. If you want to play it long, do it hedged. If you want to play it short, probably want to use defined risk via put spreads probably. That would be, I would think, the best way to play for a move if you think lower for Twitter. The semiconductor index, I think I discussed that with Intel, so we don't have to cover that again. The TLT, with all this discussion of the fear of the Fed raising interest rates, TLT has been making a move. It's been, I do believe that it could get up to the 123s, which was the 2009 crash peak high. I think that this will be a great right or right out type of a short. If it does blow through, there will be some concern about a recession and equities may suffer. So just be a little bit cautious. I do think that lower interest rates are good for equities longer term, but short term it might be a little bit nerve-wracking and you might get a little bit of a pullback in the market. So that is just what I'm thinking with regard to the TLT. Let's talk about China quickly. FXI has been, I had discussed being a buyer down in here. I had sold some puts and I've taken them off. We haven't gotten that strong of a bounce. It's kind of rolling back over a bit. I think people want to see if it can make kind of like hold a double bottom low or make a higher low. You really need to see it clear this 43.21 to make a higher high on the leg to play for some upper moves. I would, though, down here be looking for some type of a right or right out trade somewhere in near these reference lows. That to me would make a lot of sense. BABA also been. I had said that I thought the play here in BABA was long. This was the day the FXI made the lower low. BABA did not. It has rallied since. However, it is starting to get back into some resistance area. This is where the real breakdown took place. So it doesn't surprise me that there's some sideways chop. They do have a huge expiration coming up in September, a lockup coming up in September. I do think that they're going to try and manipulate the stock higher before there. Amazon had some good earnings. BABA got a little bit of love here on that, although it is giving a little bit of that up with the market. So just be a little bit careful. If we start losing 82s, I would say it's GTFO. It'll probably come back down to 80. And if you lose 80, then you're going to see these lows probably again really quickly. So 82 here, if you're long, move up your stop to 82. That to me is the key level. Amazon, what's there to say? This thing, look at this. This came up strong to the 61.618 Fibonacci extension, and then it just like blew through it. It had this huge move. It got up to like 580, although they just sold the bejesus out of this thing. I think a lot of people who were kind of playing for this move, these are kind of like the blow-off moves, kind of at the end of the move, not the beginning. You come up to a 1.618 Fibonacci extension and a channel high, and then blow it up, almost $80-$100 higher. I mean, people sell it, and the stock closed basically on the lows. So I do think Amazon is going to probably be a fairly bullish stock. They did report a profit, but it's probably not great trade location if you're first buying it on a day like this. I would be waiting, for some type of a significant pullback. These stocks are kind of just blowing off. You want to give it some time. Chipotle is a different story. I had discussed that I thought that we would see the gap fill. I said that I thought last week I said I thought we were coming back up to the bottom side of the trend line here. I did say I thought we favored seeing the gap fill, and then if we saw the gap fill and it held, we would see the old all-time highs. We did. This stock, though, however, wasn't that easy. It was down ginormously after hours. It was down like 50 or something points, and then had a $100 reversal back to the upside. back when they said that they got some of their issues that had been plaguing them during the last quarter under control. The stock absolutely took off. I would say that you probably flushed a lot of people out in those after hours, and stocks that can't go down on quote-unquote bad numbers only go higher. I do think that Chipotle will likely have some responsive selling here. The best thing it could do is just go sideways and then take off, but I wouldn't really want to be looking to short Chipotle here. It is possible that there is some type of a pullback deeper if there is a correction in the market, but the stock is fairly bullish. There's probably a lot of people still trapped short in here. I would be looking to be a buyer somewhere back down in the below the 700 area if there is some type of a pullback, maybe near the lows of this bar for a move back up, sort of like if it gets to the low end of the earnings bar, maybe for a move back up into the mid of the range. We'll see. I'll do a little bit more work on this in the week to come. Let's see. Actually, let's throw a fib on it right now. So yeah, if there is some type of a move back down to like the 50% fib retracement, maybe the 61.8. I mean, it's a big move. You could even play for that with put ratios if you start seeing it come back down. But like I said, the best scenario would be just this sideways and then it to take off if you're a Chipotle bull. FEYE has been doing what I was hoping it would do and come down ahead of the number. I'm hoping there is some type of a more selling down into like these mid 40s, low 40s to set up for a shake and bake, right or right out. I should say just a shake and bake play. I believe that these stocks all have the wind at their back. I do think that this got a little bit overextended here. It did get to the channel high. Now we're roughly kissing the channel lows and the 50% fib. If you want to play this thing long, this is a good spot to do it with a stop or hedged. It wouldn't shock me to see it come back up to the all-time high, maybe even do some type of a Fibonacci extension all the way up to here. This would to the channel high at some point. That would also be the 50% retracement from like that crazy IPO blow-off high that had sold off back up into the 60s. I do think FEYE is a buy on weakness. The bell of the ball has been this Palo Alto Networks that had the pullback. It now rallied up. It's the strongest of them. I was looking for it to be a buy right here on the 50-day moving average. Never filled my order. Imagine how pissed I am that this happened here. I did wind up playing a little bit over this high here and have benefited, although I'm not in the stock anymore. This may do some type of a pullback here to the 50 if there, maybe that to me is that, look, you can see here the 50 here have been the key levels. We stopped just shy of it here, which is fairly bullish. Any move to the 50-day is to me the buy for row plays. JetBlue, really kind of key. It broke out of this high. I do think it can see the 1.618 fib extension up near close to 25, but I had discussed taking profits here. My play had just been a call spread, and I just thought it was time to book. If this does come down ahead of the number, then I think it would set up for a right or right out long, but the market is a little bit squirrely. It has been strong. I like to buy stocks on pullbacks, not chase them on strength. Netflix, fairly bullish, has held the range of the gap up after the split. This has held up a lot stronger than I had expected. I guess it's a buy the dip stock still, preferably on trend from here to here. That would be the first stop. If it loses that, then you could play for it short for a move back down lower. I do think at some point it is going to come back and retest into, believe it or not, maybe even the 80s. I don't know when that's going to be. It might take quite some time, but the stock is pretty bullish. I mean, if Netflix does go through periods of time, though, where it isn't liked, I would wait for one of those rather than chase it up at the highs. If this does wind up just chopping sideways for a while, any take of these 117s will probably put even significantly more high into play. I will discuss that in next week's video, some levels that I think could be for the upside, but for the time being, you really would need to see this clear for the move up. If it starts losing here, you could play for a gap fill, maybe with put ratios, and I do think that there will be some support in the short term. The 50-day moving average will probably coincide with that, so that would be an absolute great right or right out, somewhere between 98 and 100. Tesla, I'm liking the price action that i.e. it's coming down ahead of the number. I was sort of hoping we were going to get weaker here. We did wind up rallying, though. The 265 level is the real key for the stock to hold over. That was an old high. If you could hold over there, then I think the 290s will be in play. I would like to actually see this thing do something like come down before the number to set up and get everyone geeked up and short and all these chaser longs out of there. I do think at some point, though, we are going to see these fib extensions up around the 232, 231 and the 359s. However, what's really surprised me and has had me a little bit more cautious on this stock is the decline in the price of oil and gasoline, and the ability for this to hold up relatively well. That is fairly bullish. I'm a little bit surprised, to say the least, but that it is what it is. So with that, I will leave you. Let's have a good trading week, and if you're not following me, my handle is @JustinPulitzer. If you like this video, hit the thumbs up button below. You can like the video, leave me some comments. That's always really, the feedback is important to make better videos. And please hit the subscribe button. You'll be able to see my weekend videos and also my rebroadcasts of my Periscope live Q&A sessions. So with that, I'll leave you. Let's have a good week, and cheers.